Every bond, every Federal Reserve transaction, every dollar in your bank account, it's all an IOU in disguise. Yet most people never see the chain behind the curtain. Behind every seemingly simple financial transaction are middlemen who control the flow of currency, profit from debt, and write the rules in their favor. This is how banks and the Fed came to wield more power than elected governments.
Watch until the end! You will know who are the creators! Who created the Federal Reserve?
The birth of the modern banking system. The genesis. Early 20th century. The U.S. had recurring financial panics. 1873, 1893, 1907, that shook public confidence. Big banks lobbied for a centralized institution to stabilize the economy.
Panic of 1873, the Great Depression of the 19th century. Trigger. The investment house, J. Cook & Co., collapsed after overinvesting in railroads. Problem. Railroads were the tech bubble of that era. Too many loans, not enough returns. Domino effect. Banks had lent heavily to railroad companies. When railroads defaulted, banks failed. Impact. Stock market closed for 10 days. 100+ banks failed. Thousands of businesses went bankrupt. The U.S. entered a 6-year depression. Lesson. Banks had no central backstop. If one collapsed, panic spread like fire. Panic of 1893, railroads strike again. Trigger. Philadelphia and Reading Railroad went bankrupt. Problem. Overbuilding plus too much debt, plus declining profits. Domino effect. National Cordage Company failed. Banks holding railroad and industrial debt collapsed. Impact. 500+ banks failed. 15,000 businesses bankrupt. Unemployment, 20% in some states. Gold reserves at the U.S. Treasury dropped so low that President Cleveland begged J.P. Morgan, yes, the banker, to arrange a private bailout loan of $65 million in gold. Lesson. The U.S. government itself was dependent on private bankers for survival.
Panic of 1907. The Spark United Copper Company scheme. Two speculators, Augustus and Otto Heinz, tried to corner the market on United Copper Company stock. To corner the market means buying up so much of a stock, commodity, or asset that you can control its supply and price. The Heinz brothers thought if they bought most United Copper shares, short sellers would be trapped. They'd have to buy shares back from the Heinzes at sky-high prices. Problem. They didn't actually control enough shares. Other traders dumped stock, price collapsed, and the Heinzes were ruined. Think GameStop 2021, but reversed. The Heinzes were the Melvin capital of their day, except they were also tied to big banks. Their plan: buy up enough shares to drive the price up, then force short sellers to cover at high prices, a classic short squeeze. Backfire. The scheme collapsed almost immediately. Stock prices crashed instead of rising. The Heinz brothers weren't exactly a J.P. Morgan or Goldman Sachs. They were reckless speculators tied into banking. But for analogy, United Copper Corner attempt equals Archegos Capital 2021. One firm's over-leveraged bets rippled through the banking system. Heinz-controlled Mercantile National Bank, NYC, equals like if a hedge fund boss also controlled a mid-tier United States regional bank, say First Republic or Signature Bank before they failed in 2023. They weren't the biggest banks, but they were plugged into the system, and when they fell, trust in the wider system collapsed. Contagion hits trust companies. The Heinz brothers had ties to trust companies, basically unregulated banks that weren't required to hold reserves like national banks. Trust companies were financial firms that handled estates, investments, and some deposits. They weren't held to the same reserve requirements as national banks. Translation: They could take in money and lend, invest aggressively with less safety cushion. Think of them as the shadow banks of their day. So when people learned that Heinz's were insolvent, fear spread. If they go under, what about the trusts? During then, Knickerbocker Trust Company, one of NYC's biggest, was caught in the mess. Depositors panicked and lined up to withdraw cash, leads to a classic bank run. Was Knickerbocker Trust Company unregulated? Yes. Knickerbocker was one of the largest trust companies in the U.S. at the time, but still less regulated than national banks. When depositors panicked, it had no Fed to backstop it. Imagine Silicon Valley Bank, SVB, 2023, heavily concentrated, risky balance sheet, no safety net when depositors panicked. Crypto exchanges like FTX 2022 operated in the gaps of regulation. Customer confidence collapsed. A bank run. Knickerbocker in 1907 equals SVB or FTX in modern form. A big but fragile player, trusted until suddenly it wasn't. The domino effect? Banks refused to lend to trust companies. Nobody wanted to be the next domino. Why did banks refuse to lend to trust companies? Other banks looked at Knickerbocker and thought, if we lend them money and they fail anyway, we lose our funds. If we don't lend and they fail, at least we're safe. Because in a run, no one wants to throw good money into a sinking ship. So they cut them off, accelerating the collapse. This is the same dynamic as Credit Suisse, 2023. Once counterparties stopped trusting them, liquidity vanished, forcing government intervention. The panic spread across New York and then the country. The New York Stock Exchange dropped nearly 50% from its peak from the previous year, and ordinary people lined up outside the banks trying to withdraw their savings. At that time, J.P. Morgan, at 70 years old, was the most powerful banker in America. The Treasury Secretary and other bankers literally went to his house on Madison Avenue and begged him to stop the collapse. Morgan locked leading bankers in his private library and refused to let them leave until they agreed to pool money to stabilize the system. Morgan coordinated with other banks and the U.S. Treasury to inject liquidity. He forced weaker trust companies to merge with stronger ones. He even handpicked which institutions to save and which to let fail. His actions stopped the panic, but exposed an uncomfortable truth. The financial stability of the U.S. depended on one private individual. The short-term crisis was contained, but confidence in the banking system was shattered. Public outrage. People realized how fragile and unregulated trust companies were. Political fallout. We can't rely on J.P. Morgan forever. Demand for a formal central banking mechanism. Direct result. In 1908, Congress passed the Aldrich-Vreeland Act, creating the National Monetary Commission. This commission studied European central banks, Bank of England, Reichsbank, Banque de France. Their findings laid the intellectual foundation for the Federal Reserve Act of 1913. The Panic of 1907 wasn't just a financial accident. It was a wake-up call and the final piece of political leverage bankers needed. Before 1907, bankers lobbied for a central bank, but the public didn't trust them. After 1907, the public was terrified enough to accept it. J.P. Morgan's role showed the system already existed in practice. It just needed to be legalized and institutionalized. To put it bluntly, the Fed was created because one man, J.P. Morgan, was acting as the shadow central bank. The panic of 1907 proved that the U.S. couldn't risk leaving monetary stability in the hands of a single private banker, no matter how powerful. The Federal Reserve Act, 1913, created the Fed as a central bank, technically federal, but privately owned by its member banks. We will go over to the member banks shortly. Be patient. Banks became the official middlemen. They could sell U.S. Treasury bonds to the Fed, creating currency through IOUs. Congress passed the act, backed by financial elites like J.P. Morgan and Rockefeller's affiliates. Public largely unaware, social trust and ignorance were leveraged to cement the system. Post 1913. Banks became the intermediaries between the Fed and the government. All public taxes, government spending, and private lending funneled through this chain of IOUs. If you want a complete breakdown, how everything ties together, not just that sequence is where most economists fucked up or intentionally misguided, click the link below. I don't want to get hang by posting here on YouTube. So from financial panics to the Fed Act of 1913, these events built the invisible hierarchy of modern money. The genesis of the Federal Reserve Act. Key figures behind the Federal Reserve Act. Congressman Carter Glass, DVA, chairman of the House Committee on Banking and Currency. Glass was instrumental in drafting and introducing the Federal Reserve Act in the House of Representatives. LLSDC.org. Check it out. Senator Robert L. Owen, D.O.K., chairman of the Senate Banking and Currency Committee. Owen played a pivotal role in shaping the Senate's version of the bill. Oklahoma Historical Society. OAS +1. President Woodrow Wilson. Although not directly involved in the drafting, Wilson was a strong advocate for banking reform and provided crucial support for the legislation. He signed the bill into law on December 23, 1913. Legislative journey of the Federal Reserve Act. Introduction in the House. The bill was introduced in the House of Representatives as H.R. 7837 by Congressman Carter Glass on August 29, 1913. House approval. After extensive debate, the House passed the bill on September 18, 1913, with a vote of 287 to 85. Senate approval. The Senate passed the bill on December 18, 1913, with a vote of 54 to 34. Presidential signing. President Woodrow Wilson signed the Federal Reserve Act into law on December 23, 1913. Motivations for establishing the Federal Reserve. Financial panics. The U.S. experienced frequent banking crises, notably the Panic of 1907, which exposed the need for a central banking system to provide stability. Lack of centralized control. Prior to the Act, the U.S. lacked a central authority to manage monetary policy, leading to inconsistent and often inadequate responses to economic challenges. Structure and authority of the Federal Reserve. Private-public hybrid. The Federal Reserve System was established as a hybrid entity, combining elements of both private banks and public oversight. Regional Reserve Banks. The Act created 12 regional Federal Reserve Banks, each serving a specific district to oversee and regulate member banks within their jurisdictions. Board of Governors. A central Board of Governors was established in Washington, D.C., to provide overall supervision and coordination of the Federal Reserve System. Monetary policy tools. The Federal Reserve was granted the authority to manage the nation's money supply and credit, the discount rate, and reserve requirements. So who actually brought the idea of the Fed into existence? The originators were a mix of bankers, politicians, and academics, but the person often credited with the initial blueprint is Paul Warburg. Paul Warburg, 1868-1932, and German-born banker, partner at Kuhn, Loeb & Co., advocated for a central bank in the U.S. as early as 1907-1908, proposed a centralized reserve system with regional banks to manage liquidity and prevent panics. Born 1868 in Hamburg, Germany, into the wealthy Warburg banking family, a dynasty of financiers with connections across Europe. The Warburgs were Jewish merchants and bankers, deeply embedded in European finance. Their banking house specialized in international trade and investments. Paul grew up surrounded by finance, learning early about credit, banking mechanics, and international markets. His father, Morris Warburg, the Warburg family was connected to multiple European royal courts, giving Paul exposure to elite networks from a young age. He wasn't just trained in banking. He was trained in influence, negotiation, and political navigation. In 1902, Warburg moved to the U.S., joining Kuhn, Loeb & Co., a major investment bank. He brought with him European banking models, particularly the centralized reserve systems used in Germany, which inspired his vision for a U.S. central bank. He initially struggled socially in New York because he was direct, highly analytical, and culturally, European New York finance was more brash and improvisational. He often clashed with American bankers who relied on personal connections over systemized thinking. Warburg witnessed the chaos firsthand. Unlike others, he didn't just complain, he analyzed the systemic flaws. He realized that the U.S. banking system was dangerously decentralized, with small banks and trust companies holding fractional reserves vulnerable to runs. Warburg proposed a network of regional reserve banks with a central authority, essentially the blueprint for the Federal Reserve Act of 1913. Warburg reportedly drafted detailed proposals months before the panic hit, but they were ignored until the crisis made reform urgent. Warburg wasn't just a banker. He was a financial lobbyist in disguise. He built alliances with politicians, academics, and journalists to push for a central bank. He believed in preventing financial panics not by luck, but by design, advocating transparency in bank reserves, emergency liquidity facilities, and oversight mechanisms. Some contemporaries called him the German financier behind the curtain, implying he had enormous influence over U.S. monetary policy before the Fed even existed. Warburg was methodical, disciplined, and highly private. He avoided public glory, unlike J.P. Morgan. Despite his German-Jewish background, he was a strong proponent of American financial independence, insisting the U.S. adopt modern banking systems rather than mimic European corruption-prone models. He had a lifelong fascination with risk management, often studying minor European financial panics to see how banks survived or failed. Secret tidbit: some letters suggest Warburg had a vision of global finance networks. Long before modern central banking or the IMF existed, he saw financial systems as tools for stability and geopolitical influence. Warburg's proposals led directly to the Federal Reserve Act of 1913. He became one of the first governors of the Fed, serving from 1914 to 1918. He structured the Fed with 12 regional banks, reflecting his European-inspired vision of decentralized yet coordinated oversight. Warburg believed finance should serve society, preventing panics that have devastated ordinary citizens. Warburg wanted the Fed to be more independent from private banks, but compromises with powerful U.S. bankers ensured the Fed remained technically public, but heavily influenced by private interests, a tension that persists today. Warburg was a polyglot, fluent in German, English, French, and deeply familiar with European financial law. He reportedly kept detailed notebooks of every panic, every bank failure, using them to model stress scenarios. Even after leaving the Fed, he continued advising politicians and banks, secretly shaping international finance. Hidden historical tidbit. Warburg had early warnings about Germany's post-World War I hyperinflation, advising U.S. policymakers to understand European instability to protect American banks. European banking dominance. By the late 19th century, Rothschilds were the most influential private banking family in Europe. Their networks shaped global finance, international credit, and sovereign debt. Idea channels. Many American bankers, including Warburg, were part of or influenced by the same transatlantic banking circles. Warburg himself was German-born, from a banking family closely tied to Rothschild connections. Private central bank precedent. European nations. Had central banks controlled or heavily influenced by private banking families, Rothschilds, Warburgs, Baring family, etc. U.S. elites borrowed the model, seeing how centralization plus private control could stabilize markets without democratic oversight. Symbolic hierarchy and diagrams in visualizing Fed origins. Rothschilds represent the ultimate node of private banking power, the historical shadow guiding transatlantic finance. Not that they ran the Fed directly, but the blueprint and philosophy originated in that world. A short biography of Paul Warburg, then the key politicians who made it law. Carter Glass, House, drafted the House bill. Robert L. Owen, Senate sponsor. President Woodrow Wilson signed it into law in 1913. In November 1910, a private meeting at Jekyll Island, Georgia, with bankers like J.P. Morgan, Paul Warburg, Frank Vanderlip, and others planned a blueprint that heavily influenced the final Federal Reserve Act. This is why some call the Fed a banker's invention, even though Congress officially passed it. Back to Members Bank. It's called federal, but it's federal in the same way Federal Express is federal, a hybrid creature. The U.S. government doesn't own the Fed. The banks do. When Congress passed the Federal Reserve Act of 1913, they designed the Fed as a weird hybrid. Public facade. The President appoints the Fed Board of Governors, D.C. policy side. Private engine. 12 regional Federal Reserve Banks are owned by member banks in their districts. Who counts as member banks? All national banks, those with national charters, were required to join. State-chartered banks could optionally join, and many did, especially after amendments in 1916. Each Fed district has a president. Only 5 out of 12 presidents get to vote on Fed interest rate decisions at a time. The 12 Federal Reserve districts. The U.S. is divided into 12 districts like slices of a pie. Each district has a Federal Reserve Bank headquarters that serves banks in that region. Each one has a Federal Reserve Bank HQ. Boston, District 1, New York, District 2, Philadelphia, District 3, Cleveland, District 4, Richmond, District 5, Atlanta, District 6, Chicago, District 7, St. Louis, District 8, Minneapolis, District 9, Kansas City, District 10, Dallas, District 11, San Francisco, District 12. Inside each district Fed has many member banks. Member banks equals the commercial banks, big and small, that buy own stock in their district's Fed. Example, New York Fed has hundreds of member banks, J.P. Morgan, Citibank, Goldman Sachs, Bank of New York Mellon, plus smaller community banks. Member banks equals any nationally chartered bank. By law, every nationally chartered bank had to buy stock in their district's Federal Reserve Bank. State chartered banks could choose to join, many did. It's like a membership is ongoing. These banks must purchase shares in their regional Fed bank, entitling them to a fixed 6% dividend, but these shares are non-tradable. So the shareholders of the Federal Reserve banks are the commercial banks themselves. So there are two types of shares in itself. 1. Restricted shares, mostly employees, sales reps, or executives. Definition: shares that can eventually be sold, but only after certain conditions are met. Typical conditions: vesting period. You earn the right to sell them over time, for example, 25% per year for 4 years. Performance conditions. You meet certain goals or milestones. Lockup period. Sometimes after an IPO, employees cannot sell immediately. Who can you sell to? Often you can only sell to the company itself. Approved investors or under an internal market, not freely on public exchanges, unless it becomes public later. Purpose: keeps employees or insiders committed to the company and aligns incentives with long-term growth. 2. Non-transferable shares. Definition: shares that cannot be sold or transferred without special approval, sometimes never at all. Typical uses: family-owned businesses to keep control within the family. Private companies that don't want outside investors influencing decisions. Venture-backed firms might allow founders or key executives to hold voting shares that are locked in to maintain control. Who holds them? Usually insiders, meaning founders, key executives, board members, family members, and family businesses. Purpose: absolute control. It prevents outsiders from buying in and changing decisions, even if the company grows or raises capital. I repeat, so the shareholders of the Federal Reserve banks are the commercial banks themselves.
Scenario setup: commercial bank issues shares as bonuses. Say the bank has 1,000 restricted shares. They distribute them to employees and sales reps over a vesting period. Each share represents a claim on future profits of the bank. Obligation to Fed. Bank borrows from the Fed district or holds reserves there, paying 6% annual interest on that balance. Fed district collects this interest and passes all net earnings to the Treasury. How do we value those employee shares? Step 2. Employee share allocation. 1,000 restricted shares are given to employees. Each share equals proportional claim on bank profit pool. If these are restricted, employees may only sell after vesting, say 4 years, but they earn the economic benefit as the company grows. Step 3. Impact of Fed interest. Annual 6% payment reduces the total profit available to shareholders. Essentially, Fed is like a silent corner, taking a slice every year before employees, owners get theirs. If bank borrows more from Fed slice increases, shares are less valuable. Step 4. How shares are valued. Book value method. Based on net assets of the bank. Profit claim method. Based on projected future profits like above market method, if shares are traded, valuation is determined by demand and liquidity. Restricted shares often use shadow valuation based on profit allocations rather than market price. Non-transferable shares might not have a market value at all. Their value is control plus potential future payout if company sells or initial public offering. Step 5. Play with hypothetical growth. Suppose bank net profit grows 10% annually. Employee shares are vested over 4 years. Vesting means employees can cash out or convert these accumulated profits into cash or stock after 4 years. Fed interest 6% compounds yearly. If the bank maintains the debt, this slightly reduces growth available for shares.
So the Federal Reserve is like a country club for banks. You pay membership, buy Fed stock. You get guaranteed perks, dividends, and you get to vote on some rules of the House. But the club manager, Board of Governors in D.C., pretends it's run for the public. In reality, the richest banks in New York have always been the loudest voices. They don't control Fed policy outright. That's the Board of Governors, but they elect 6 of the 9 directors of each regional Fed bank, collect guaranteed dividends, provide the capital base for the Fed system. Flashback. Member banks back in the day, 1914. When the New York Fed opened in November 1914, it began with 211 member banks. Across all 12 districts, the number was in the thousands because every national bank was required to join. Think of the Fed like an exclusive country club for banks. You buy a ticket, that 6% dividend stock, and you get club privileges, influence in board elections, and access to Fed services. Meanwhile, the public-facing side pretends it's a federal institution, but the real owners are the banks themselves. Over the century, bank mergers plus consolidations shrank the number of players. Today, while there are still hundreds on the member list, real power is concentrated in maybe 6. It shrank to a cartel of 6 to 8 giants that matter, while hundreds of smaller banks are just along for the ride. Why New York Fed equals the real powerhouse? 1. Wall Street equals the money pipeline. The New York Fed sits on top of Wall Street. Almost all Treasury securities, repos, Fed lending operations happen there. When the Fed buys or sells bonds, QQT, it's the New York Fed traders doing it, not the Fed in Washington. Custodian of U.S. gold reserves. The largest gold vault in the world is under the New York Fed, not Fort Knox. That's a Hollywood myth. Central banks around the world park their gold there. That makes NY Fed not just American, but the world's bankers' bank. Emergency bailout machine. 2008 Lehman crisis gives New York Fed led all the emergency lending programs. 2020 COVID crash gives New York Fed launched multi-trillion repo plus QE facilities. Washington, the Board of Governors, sets policy, but New York executes the real-world money firehose. The voting structure. Each Fed district has a president. Only 5 out of 12 presidents get to vote on Fed interest rate decisions at a time. But New York Fed president is a permanent voter, always at the table. Other districts rotate. Translation. New York always holds the trigger finger on rates and markets. New York Fed's balance sheet and assets dwarf most of the other districts combined. Atlanta, Dallas, St. Louis, etc. are more like regional offices. New York equals the capital of global finance inside the Fed system. The 12 districts are like Game of Thrones houses. Most are local warlords. Atlanta runs the South, San Francisco the West, Chicago the Midwest. But House New York holds the gold, commands the Treasury bonds, and never rotates out of power. Washington pretends to be King's Landing, the capital, but it's really New York that rules the realm. New York equals the capital of global finance inside the Fed system. The passage of the Federal Reserve Act marked a significant shift in the U.S. financial landscape, establishing a central banking system designed to provide stability and oversight. While the act addressed immediate concerns, it also laid the groundwork for ongoing debates about the balance between public oversight and private interests in the nation's monetary system.